how do you see inflation panning out, and to what extent do you take inflation into account when selecting a stock? And invariably that will intertwine with, you know, your view or not view around interest rate cycle as well, Terry.
Yeah. Okay. Yeah. Yeah. I mean, obviously those are topical. And finally, I think let's go back to my upbringing, or at least my early career again. We're all very subject to recency bias, is the first thing I would say if we're not careful. And people talk about inflation a lot now because it's an issue in their minds, and they're not wrong to think about it. I'm not suggesting they are for a moment, but you need to get it in perspective. I started work in 1974, late 1974, and my first full year in work was 1975. I wonder if I give your listeners a moment to guess, no Googling you lot, what the CPI went up by in 1975 in the UK. 24%. Right?
Wow.
Wow. Yeah. Now I lived through that. You went back to things you learned in the past. I've seen real inflation in action. Right? And I can tell you, how do I see inflation panning out? I simply don't know. I mean, I don't feel that I've got enough insight into this to say. However, I'm not totally pessimistic about it, although we've clearly got inflation at the moment. The reason I'm not that pessimistic about it is, if you look back at the facts, always a good place to start, you will find there's not any positive correlation or strong positive correlation between commodity prices and retail prices. In fact, there are quite strong negative correlations in a number of commodities over time. And the reason for that, and this comes back to how do you, because you said, well, Terry, how do you select companies report, is the first impact of inflation is not on consumers, it's on companies. You know, we don't buy commodities. You don't go and buy commodities. You buy things that have been processed by companies to buy. Even when you buy, nice, well, I buy oil. No, you don't. You buy gasoline or diesel. You don't buy oil. When you buy food, it's agricultural commodities which have been processed to deliver to you, or it's electronics, things that have been processed in terms of resources, in terms of cobalt and so on, and lithium to make electronics. The first impact is on companies. It's not on, and that may work through companies into consumers in the end, and then we'll have a real inflation, which means this: if you're trying to think of what company do I want to own in an inflationary period, own one with a high gross margin. Gross margin is the difference between revenues and cost of goods sold. Companies take in stuff, they take in ingredients, components, services, do something to them, turn them into a product and sell it to you. And that's your gross margin, difference between those two things. The average gross margin in our portfolio is 60%, which is, to put it in English for you, they make things for 4 and they sell them for 10. The average on the index is 40%, which is to say they make things for 6 and they sell them for 10. Now, if you're going to have a period of inflation where the cost of goods goes up by 10%, right, it's clearly a lot better if it goes up from 40 to 44 than 60 to 66, basically. The impact on your profitability, which was lower in any event in the other companies, is much greater. High gross margins are a buffer for companies, and they are also a measure of their pricing power. I mean, the best gross margin companies in the world are people in the software business and people in goods where the cost of goods are very low, things like cosmetics. And in their case, I think you could have inflation and it wouldn't matter at all, basically. So that's where we look at it. The one thing where inflation, I think, will have quite a lot of impact negatively on not just our companies, but the market in general, but probably disproportionately high on us, and you touched upon it, is if there is a big pickup in inflation, which persists. And that's the other thing. It's not just whether we've got inflation. We've obviously got very unusual circumstances at the moment in terms of COVID, the pandemic, the recovery, and the supply chain. I don't think we'll know whether we've got secular inflation until we've lapped that. But if it does persist and requires central bank action, interest rates will go up. And when interest rates go up, valuations come down, basically. So I'm not, when you think about our portfolio, I regard it as a two-stage question. Terry, if there is inflation, are you worried about the fundamentals of your company? Not much, and certainly not compared with the market. Right? Are you worried about valuation? Yes, quite a lot. I think it could have quite a profound effect on valuation if inflation takes hold, persists, and there's central bank action.